When I was dollar cost averaging stocks in 2001, 2002, 2004, 2005, my broker would say, man, it's great. You built a plan and you're executing your plan. Passive investing is the same. You still need a dollar cost average your investments. You need to diversify and you need to do your own due diligence.
Thank you for being with us every day on the Real Estate Syndication Show. I've got a gift for you, but I want to ask that you will leave a written rating and review on iTunes. If you'll send a screenshot to info@LifeBridge Capital of that review and a mailing address, I want to send you one of my recommended monthly books. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is David McIlwaine. He has a real estate vast experience spanning over 20 years, knowledge, understanding the industry gained firsthand, either by owning and having owned multifamily units, commercial real estate development, single family, vacation rental properties, second homes, and custom builds. He's done a lot of different things in real estate, but many of you are going to connect with his story today and being that, say, that high paid executive or that high paid salesperson who, you know what, that position may not always be there. And I think that's like often in the back of our minds, right? You think, well, we'll always have this job or not. And I'd say, whether you think you will or not, you better be planning to not. And our guest today, David's going to help you with just that and thinking through, man, how can you use, that income today to be prepared for when that JOB is no longer there. Maybe there's a time you don't want it to be there, right? And maybe you want to leave that JOB. Well, it's going to help you do that with the information he's going to share with you today. David, welcome to the show. Honored to have you on because I know many of our listeners are going to relate to your story today and going to learn a lot. Tell us a little bit about that story and let's dive in about who you are.
Well, thanks, Whitney. Great to be here. I'm a recovering Fortune 500 sales executive who got into the real estate world. I had golden handcuffs, and I used them to parlay that into a successful career in real estate. Short answer is I was laid off twice in 18 months after having hit deliverables and through no faults of performance or reality. And I've come to realize that I have a story to share with people. It's not a matter of if you lose your job in the high performing sales world, it's when. And my objective here is to teach people how you can take your golden handcuffs and actually make them golden feathers so you can build net wealth for your family. When it's all said and done, I'm a general partner in 1,000 Doors, and I'm based in Denver.
Awesome. Well, you mentioned, it's not a matter of if, but when. If I was in that position, that might make me a little nervous to hear that. Potentially, I don't know. But speak to that person a little bit that's thinking about, hey, maybe this is me, maybe it's not. Maybe describe that individual a little bit that you're speaking to when you say that.
Yeah, and that individual is who I was. I was seat 1D on the airplane. I like it on the aisle on the right-hand side because I'm left-handed, so that way I can write and not hit anybody. And I cross my legs that way. So that was my chair. We're the guys that get up on a Monday morning at 6 a.m. We go to the office for 5-7 hours, catch a 3 p.m. flight. We come back Thursday night at 5 p.m. and we hit 1, 2, maybe 3 cities. We've got teams that we work with. We have pressure to hit SOX compliance issues. We have pressure to hit quotas. Now, with technology the way it is, we have pressure to put everything we do on a CRM that allows us and our management teams to maximize performance through dashboards. And the reality is that we make great money because we're under great stress and we get paid to survive that stress. However, the world is such that corporate America looks out for itself and they never look out for you, the top performing employee. I literally made budget for the 9th consecutive quarter in a row the day before the quarter started. And I got laid off the next day. And then everybody else at my level got laid off that same day because of a merger. And the new company decided that they didn't need the executives that were doing what we were doing. So I've been there. I've done startups with tech companies. Came in one day, got a Series B funding round secured. And I actually met with a VC guy yesterday and was telling the story, and he totally understood it. And I came in and I said to my CEO, okay, we got a business plan to hire 35 sales executives. Let's go. And she said, I paid off all my debt. I said, what debt? The next week I was laid off because I had reversed 5 quarters of negative revenue decline. However, we couldn't get the needle fast enough to keep the doors open. And if you're in the startup world, this is a very familiar story.
Yeah.
If you look at Amazon or you look at Twitter or you look at anybody in the news right now, we're recording this the first quarter of 23, and layoffs are prevalent. It's the same thing that happened in 2000. Same thing that happened in 92, same thing that happened in 2008. We go through cycles. And if you're a high-performing sales guy, you're going to lose your job. Just a matter of when. And if you don't, you are a unicorn. I can't tell you the number of friends I've had that have gone through this. And unfortunately, none of us have horns on our head, so we're not really unicorns. We have golden handcuffs and we hate.
I have seen
Yeah.
numerous ads where at Google, Facebook, I mean, just tens of thousands of layoffs, as we speak. I would mention that LifeBridge is hiring though, which maybe that seems odd, but we are for a few positions. Maybe I'll reach out to Google. But anyway, no doubt, David. I mean, it's like, with the W-2, and it was I wasn't a high paid sales guy by any means. However, even when I had a W-2, it was just something I knew that I couldn't see myself doing forever. But everybody in my family and sphere of influence at the time did see that as this quote, secure position, right? And you had benefits, and it was the golden handcuffs, like you're talking about. It was like, oh man, what are you doing? You can't quit that. It's so good, right? But man, it was exactly what you're talking about. But I would love for us to dive in to help those individuals to be prepared, right? When this happens, right? Like you say, how can you help them to be prepared for that?
Well, the first thing you got to do is you got to make a plan. And you got to look at your taxes. There's an old adage that it's not what you make, it's what you keep. I remember during the first Gulf War, I was literally looking at my tax burden and I was buying a missile every year for the US government. And I remember I was at my grandfather's funeral, actually in Virginia, as it were, and we were laughing about this. And that's when I really got to pay attention to the tax structures. And one of the benefits of real estate, if you make a plan, is that you can create tax strategies to defer tax, to reduce your W-2 tax burden, to actually lower your effective tax rate. One of the things as a W-2 employee is that you don't have a whole lot of deductions. And with the Tax Act change in 2007, we really changed it out. So one of the things that I did was I opened a side hustle company, which wasn't called a side hustle back then, but it allowed me to create a different stream for some revenue. Was it legitimate? Absolutely. Did I have a legitimate offering? Absolutely. Did it affect my W-2 effective tax rate? It dropped it by about 9 points, which might not sound like much, but if it's $100,000, that's $9,000. And if it's $500,000, 9 times 5 is $45,000. That's a new Mercedes at that point.
If somebody doesn't think that that's much, I'll just call me. I'll be glad to take that off your hands.
Yeah, you can write a check. It's David, MCIL, right? No problem. Yeah. And so first is build a plan. Second, you have to look at your retirement structures. One of the things that used to drive me crazy was when I was in the advertising business. So I worked for a division of Viacom, and they had a very poor 401k match. And as a highly compensated employee, I couldn't contribute to Roths. I couldn't contribute more than the 2% average above the company norm. So I think I was capped at 7% contribution levels. And so I had to go find other alternatives. And the rules have changed since then. And now you can do things with Roths that are bigger. You can do things with self-directed IRAs that really were not germane at that point in time. And if you don't have a self-directed IRA and you have all of your money in your company 401k plan, you're sitting on a block of dynamite. If your General Motors employee and GM goes bankrupt like they did in 2008, what happens? If you're an Amazon guy, and let's say that Bezos figures out a way to monetize the next magic and Amazon falls in value. If all your eggs are in that W-2 employment basket, you're not diversified. And one of the things that we do with alternative investments in the real estate field is we create some diversification. So putting money in a self-directed IRA and buying real estate in a self-directed IRA, or in a solo 401k if you are eligible to buy one, or a self-employed IRA, a SEP, is another great way to do this. So that you actually structure things in a way that you have tax deference. It's not avoidance because you're going to pay the man at some point in time. But the less you have to pay, the better. I don't know, I'm kind of talking in a high level, but if you think about it from how did Mitt Romney run for president? And he had $100 million IRA. It's one of the questions my father asked me back in, I think he ran in 2012. I don't remember the exact year. But the reality is that he had a self-directed IRA. And he put compensation in there and let it ride. If you put compensation in, or if you roll over when you're changing employers and you roll the money over from your previous 401k to a self-directed IRA, there's no contribution requirement that says you've got to only put in $5,000. You can roll over an entire process when you change employers. If you're not doing that, you're leaving money on the table. Or if your 401k is too high, you can roll over a percentage of it. The ultimate question is for people that are in anywhere above 30 and older, is that we are now the first and second generations that have to provide our own nest egg for retirement. There is no pension. There is no safety net, right?
Yeah, you better be thinking about it. That's for sure. Early as possible.
Right. And like my dad was a 28-year vet. And so he's got a military retirement. He's got an American Airlines pension, and he's got 4 streams of income. If I don't use my handcuffs to build other income streams, I'm living only off my principal. And as a highly effective sales rep, that's like living off of the current client base with no pipeline for new biz. It's a kiss of death.
Yeah.
And I think it's crucial that people investigate that stuff.
I wanted to just back up just a little bit, though, because one of the first things you said was make a plan. And I know this can seem pretty overwhelming, right? We're already pretty scared because we think we're going to lose our job, or we know we're going to lose our job. But we're talking about IRAs and Roths and self-employed IRA and some of those things. Who could we talk to, like, to figure some of this out, or any recommendations on where to educate ourselves a little bit better on what path, or even how to make a plan? Because it can seem daunting, like, well, I don't even know what I should consider. Like I just hear it often, right? Well, I don't even, like, who do I even talk to figure out what my plan should be?
So let me walk you through what my experience was. And I'm not going to give any names for anybody specifically, because I think everybody has their own situation. I will tell you, I'm getting ready to launch my own podcast focused on this called Break Your Golden Handcuffs. And I will dive into this in depth. But the basics thing is, I started talking to my accountant. I started talking to my financial planner. I started talking to my trust estate attorney. I started talking to my human resources department. And then I started really researching what the options were. My accountant said to me, you got to have some deductions. Go build a company. So I did a side company. That immediately allowed me to have a series of deductions for legitimate business expenses that I couldn't maximize because I was at a compensation level where the deductions were capped. But in a business, you can have ordinary expenses aren't capped. They're not capped. It's a one-to-one deferral versus ordinary income. So that's a big part of it. The second thing was that I was able to build a structure where instead of getting income paid for my business, I got paid dividends. So I talked with my accountant to work through, how do you get paid different systems? A dividend is paid once, maybe twice. A constant paycheck is pretty self-explanatory. And the difference in tax rate is, one is at normal tax burden and one is at a 15% capital gain structure. Big difference. Short-term, long-term, depends on their situation. And so you start to think about, what can I do to add to my tax complications, to add to my picture, to make it more complicated in essence, but it actually simplifies it. So if you're a passive investor in a real estate business and we go through cost segregation and you get a loss of $25,000 a year to use, that devalues over time as you make more income. But there are ways to carry that forward if you talk with an accountant. I'm not a CPA. I just did this by myself because I had to learn it. And what I learned allowed me to have commissions from 2000 still making me money today. Bonuses from 2012 are still making me money today. And the objective when you're working with those people and you're in corporate America is to build yourself not a golden parachute, but a safe place to enjoy life. And I think that the plan starts with those 3 professionals: your trust attorney, your accountant, and your financial consultant. And then I would spend a lot of time looking at guys like myself or guys like you who make our living helping people build their net worth.
Yeah, for sure.
I don't make any money unless somebody else makes money first.
That's right. It's interesting, when we started the business and all that stuff, we're having to learn all that ourselves as well, right? But for me too, right? I mean, as far as IRAs and whatnot, and leaving a W-2 position and thinking about, hey, what do I do with this? Now that I'm self-employed. Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team I've created called Vox Valens Media is now available to produce shows for you as well. We can do as little or much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing more valuable tasks in your business. Let me know if you're interested by emailing me directly at whitney@lifebridgecapital.com. And maybe speak to that transition a little bit and what that looked like for you. But then also, what does this look like as far as, this IRA? Do we have to do it immediately? That transition, can it sit there for a while? How urgent should they feel about making this happen?
Well, I never want to put somebody in a sense of urgency around their own retirement structures. I have a quote on my wall from Marcus Aurelius that reads, "No theft of free will reported." So everybody has the choice of how they want to do these things. What I would say is it doesn't take long. I was able to open my solo 401k and my self-directed IRA, each of them in about 15 minutes. I found a third-party bank. I filled out the forms. I then ordered actually, I have Schwab, so I guess they'd be my brokerage, to transfer money as an approved transfer from Fund A to Fund B. There's no difference in the mechanics, except for you can't hold it yourself and you can't personally benefit from it yourself. But if your IRA or your 401k is funded by your earnings, the IRS views those as separate entities. So imagine that I'll just talk first person. There's David, then there's David's 401k, then there's David's IRA. To the IRS, I'm three different people.
Yeah.
And when you get that hurdle in your plan, you can understand the difference. And as far as my transition goes, I was in corporate America, that second layoff of the tech company. I was in the middle of a divorce and I couldn't travel anymore because I became a single dad of kids that were in middle school and elementary school. So I chose to leave corporate America at that point in time. And I got into real estate because I had built a nest egg from my golden handcuffs. And I decided I couldn't live on a plane and be a dad. I could, but I chose what was valuable for me and my family, and I will never regret it. So that's how I got to this world. I didn't want to leave corporate America. Just life happened and it put me on a path. And as far as moving, the timing on this kind of stuff, I've got a friend who's in the high level insurance guy, and he and I have been talking about it for 18 months. So at some point, he'll see the returns from one of our offerings and he'll decide, oh, that really was good. And until that time, we keep talking about it, because the reality is that there is no time that's better for anybody than anything else. There is a hypothesis, though, that you buy real estate and you wait. And so if you can't buy the real estate yet, you can't start waiting. If you're waiting to take action, inherently, you're losing something.
If you wait till you need the funds, you don't have time to wait.
Right. And it takes about 45 days to do the whole thing when it's all said and done, depending on who your providers are like. Some providers are faster, some providers are slower, some take 90, some take 2 weeks. Yeah. So it's like everything else in America. Everybody's got their processes and their systems, but it's not overwhelming.
And most people don't realize, and I'm glad you brought it up, that you can't benefit from these funds, right? So you can't do certain things. But I mean, like you want to go buy a rental property, you could use this for that. However, you can't go work on it, right? Or somebody else has to do all the work, or it has to be
your family can't live in it.
Right. That's right. That would be benefiting, right? Or your child, or
gotta be an arm's length transaction from anybody, right? Yeah.
Yeah.
And the thing that's fascinating about these that people don't talk about is if you own it free and clear for 366 days, there's no boot. So there's no unrelated business income tax or UBIT. So one of the models that I've had people work with is that you go out and you buy a rental property. And I also own a residential brokerage in Denver, but you buy a rental property, you put it on a 15-year mortgage, and you buy in your IRA. So your IRA can actually incur debt. From that debt, you can pay it off in 15 years. You hold it for 16 years, you own it free and clear. No tax benefit. Your IRA has this thing. You bought it for $200, you sell it for $400, you got a $200,000 gain that's free and clear. 16 years in the making, right?
Yeah. Wow. What if you paid it off, like you just paid cash for it and owned it for a year?
Well, great. More power to you. But if you pay cash for it, you got to have enough money in your IRA to do it. In Denver, the average cost of a rental property is $450. The mean house is $550 in Denver. So most folks don't have $500,000 sitting in their IRA.
Yeah. And you wouldn't want to put it in one property if you did.
No, you want to diversify, right? That's part of the plan.
Of course. So any other just steps that somebody should know, or that maybe is going to hold them up when they start this process, or frequently asked question that holds everybody up as well as they're looking forward to this from this position?
How do you provide providers? How do you vet the providers? So from that point of view, it's pretty easy to do that research online. If you have questions, you can always ask me. I'm happy to help you. I use solo 401k. I use a local bank in Colorado for the self-directed IRA. There are a whole bunch of IRA companies out there that make a lot of sense. And the reason I talk about this is that you can also buy multifamily or commercial syndications inside of IRAs. So you can still do the same thing without having to take on that burden of toilets, tenants, and termites. And it's easy to go through that process. So I guess the question is, if you really are curious and you need some vendors, send me an email and let's have a dialogue around what you specifically need. And I'll point you in the right direction. I don't know if that answers your question or not.
Yeah, no, that's helpful. That's helpful. I just know, when somebody thinks they're going to start this process, there's always like speed bumps, right? That, kind of knock you off track, and then you spend another, you forget about it for a bit, and then you come back a week later. And so it's helpful for listeners to have a place to go to figure out, hey, you want to hit that hurdle or whatever it may be, I can get some help.
One of the things I wanted to interject on that was the big boys, Schwab, Fidelity, Merrill Lynch, Chase, those guys don't want you doing this because intrinsically you're taking money that's under management outside of their purview.
Right.
So you're going to have to look at the smaller fellas, the smaller intermediaries. And those are the ones, like in Denver, we've got a local bank called First Bank, and they do a ton of self-directed IRA work. I've got another bank, I can't remember the name of it right now. It's where I actually bank my stuff, and I would tell you if I do. But don't go to Schwab and say, hey, I want this. They do have some of them, but it's harder to get to it.
Yeah.
And that's important to note.
David, do you have any predictions for the real estate market over the next 6, 12, 18 months that you could share?
Yeah, it's going to get ugly.
What does that mean?
Yeah. I think there's an awful lot of operators that have very risky debt that's going to come due. The Fed changed the interest rate 7 times by 400 basis points? I don't remember the exact number, but it's an obscene number, right? The highest Fed rate in 40 years. So what that means is if you had a variable rate mortgage, your costs have skyrocketed. And even if you have a rate cap, depending on where your rate cap is, and a rate cap obviously is an insurance policy that you buy to protect yourself from that variability, you got to get to that strike point to get that rate cap in place. So there's going to be a lot of operators that have been over leveraged because of bank debt. And commercial banks are on 5-year notes. So a lot of this stuff cycles through. So if you bought something 3 years ago, you're come to renewal. You might not have the process in place to actually generate a renewal on your new debt. And there you're into forced liquidation. So I see that as a possibility. I see from the residential side a flatlining in certain major metros. I don't think we're going to decrease in some metros, but we'll flatline. And our growth, which has been double digit, is going to sink to very low single digits. The consumer, once they get their head around the idea that they got to pay a 5% mortgage, can live with that. But for a whole generation of Americans, we've never seen debt that high, and they have to get their head around that. And housing prices will fluctuate a little bit to get to that stasis. But I see a lot of opportunity to buy distressed assets.
What about any thoughts preparing for a downturn like that? If you're buying an asset now, or maybe bought one, a year ago, how would you suggest, being prepared for a downturn like this?
Yeah, great question. So if you bought something a year ago, you're already pot committed. And the best thing you can do is focus on operations, right? Yeah. Focus on keeping operations high and tight, as they say in the service, and make sure that your PM's on the ball, keep your occupancy up. If you're acquiring right now, as the brokers say, there's a disconnect between the ask and the bid. And right now, the spread between buyers and sellers is not normalized. It's starting to. And I think the key there is to look at this from a longevity hold. Real estate was typically a 7 to 10 year play until the last cycle of the last 4 or 5 years. It's just become a 3 to 5 year play. So if you go back in and you rechange your thought process to a 5 to 7 to 10 year hold, the cycle's going to normalize. I've seen stats that say that when the Fed starts raising rates, about 18 to 24 months later, they start dropping them. People are talking about a drop in the fourth quarter of this year. We had some good news earlier in January on some financial stats, unemployment and jobs. So people are talking about it. The Fed's supposed to, when this thing comes out, our interview comes out, the Fed should have had their next raise, and hopefully it's 25 basis points, and that'll indicate to the economy that there is hope for a soft landing. It's possible. You got to have hope for it.
Yeah, it is possible. I don't think anybody knows exactly what's going to happen, right? I ask all kinds of people. But David, what is your best source for meeting new investors right now?
My best source is really podcast speaking, podcast talking, and then conferences. What I have found is that people are scared and they're skittish. And I keep reminding people that fortunes are made when people are scared. And the biggest, most successful investors have been contrarian. Warren Buffett says when people are giddy, sell, and people are scared, buy. And I think that we're right in that cycle. I remember 2008. If you waited a couple months, the dominoes fell pretty fast. You buy in the beginning of 2009, you're pretty happy because Lehman went belly up in the fourth quarter of 2008, right?
Yeah.
And then if you're not quite sure how to time the market, and I don't suggest timing the market, remember that the 2008 drop was neutralized by 2010. In some markets it wasn't, but across the US as a macro, it was neutralized. So we're going to have these drops, and it's like buy on the dip. Prep for buying on the dip is my process.
What's a syndication struggle that you've had in business?
Yeah, there's a bunch. The number one struggle right now is debt, right? Finding the right debt. The debt markets have not seized. They've definitely become tighter. And the biggest thing to underwriting right now is to get stable debt. If you don't have stable debt, you're really banking on some big risk unless you're an institutional guy and you have the liquidity to play that game. I'm not an institutional guy. I don't play that game. I think the other thing is there's a disconnect between the sellers and the buyers. The sellers are still thinking it's the fourth quarter of 2021 when it was a go-go time for your listeners if they weren't familiar with it. And it's not the same environment. Markets change really quickly and people's brains lag the reality of what the economic state. And those are some of the biggest disconnects I'm seeing today. And then we've also got another problem, which is employment. And this might be a little controversial, but I think that we have a tremendous problem with immigration. We need more immigrants in here that are willing to do jobs that I can't hire for. It's been a real challenge being able to find employees because we've got this shrinkage of the employee workforce. And people say the immigration is a problem. I'm like, yeah, it is. We need more people to come do jobs that we have vacant. I can't keep full staffs because people are deciding they don't want to work. It's a problem.
Yeah, we've been in a number of hiring processes. It's difficult. It's difficult to find people, no doubt about it. What about your best advice for passive investors?
So is to take action and continue to execute your plan. When I was dollar cost averaging stocks in 2001, 2002, 2004, 2005, my broker would say, man, it's great. You built a plan and you're executing your plan. Passive investing is the same. You still need a dollar cost average your investments. You need to diversify and you need to do your own due diligence.
What are the most important metrics that you track? Could be personally or professional.
Great question. So I track several metrics. I'm tracking impressions on LinkedIn posts and impressions on podcasts and downloads and those things. Those are all KPIs from a marketing structure. I track LOIs versus full underwritings executed. I track raises, dollars achieved by partners versus dollars committed, all kinds of simple things. And then on a personal level, I track exercise days. I track meditation days. I track my weight. I'm working with a health coach right now and I've lost about 25 pounds. And so for me, it's become almost obsessive and I'm tracking every day what's happening. I also track calories and a bunch of other stuff.
Well, at least you track it. So at least you know, right?
Yeah,
that's
I
awesome.
know.
What about, how do you like to give back?
I love to swing a hammer with Habitat for Humanity. I love to work with kids. So I've been very involved with the Boys and Girls Clubs of Metro Denver for years and years and years, and helped found their associate board, which raises 6 figures a year for technology investments and to provide some operational cash flow for the companies. I know you're a big adoption guy, and I think it's crucial that we all find some way to support our community.
Awesome. David, I'm grateful for your give back to us today and helping us to think through, hey, that job may not always be there. And I hope that you're preparing, especially somebody like that, you got a great income right now, but man, you better be preparing for when that income's not there. And so it is on our back, right? To ensure we're doing that and prepared for the future when we don't have those handcuffs anymore. So David, how can the listeners get in touch with you and learn more about you?
macassets.com, macassets.com is the best way. And you can connect with me on there, reach out and start a dialogue.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.